Okay, so good morning, everyone. Welcome to this edition of the Macro Snapshot. We are Tuesday, April the 1st, April Fool's Day, 2025. Everything I say in this podcast will be absolutely true. No April Fool's jokes here. Okay, so we had the end of the quarter, beginning of the new quarter. We have a little bit of data coming up this morning. Some of it sort of soft data, some of it a little more kind of concrete. The soft data we have is the ISM manufacturing. Again, this is going to be important just to see what the state of the US economy is. Well, this is not the only indicator, but to start giving us clues about the state of the US economy and whether this narrative that the US economy is maybe sort of stalling or growth is de-accelerating, et cetera, et cetera. We'll see whether we get a bit more input into that. So obviously, let's look at the headline number, which is expected to come in a little bit in contractionary territory, just under 50 at 49.5. But as you can see here, the prices paid are expected to come in the mid 60s. Very, very strong. So we don't want to get this sort of situation where prices paid is going up, sort of growth is going down, a kind of a stagflationary kind of dynamic. And that's what the market seems to be sort of concerned about at the moment. Let's also look ahead at new orders, which is coming into the system, views ahead on that. And then, of course, the employment situation. Now at 47.2, a little lower than last time. So starting to go downwards a little bit, but keep in mind that later in the week we get the ISM services, which seems to be a sector which dominates the US economy and which is actually a lot stronger, it seems, on paper than the manufacturing sector. So that's that. The other thing is, at the same time we get is the job openings and labor turnover survey, the famous JOLTS. Interesting to look here at the quits level, how many people are voluntarily quitting their job, leaving their job. And the logic here is that the less people are confident, the less they will voluntarily leave their job. So we want to see if the quits level and the quits rate is going up or down, or it's just stable, then the layoffs. And one of the narratives, just in terms of the JOLTS report and the labor market in general over the last 2 or 3 months, is that people are not being fired very much, but employers are not particularly employing a lot of people. So there's a kind of a sort of an equilibrium and stability. So possibly by 10 o'clock today, as I say, after we get the JOLTS number and the ISM manufacturing, that'll just feed a little bit into the market narrative of whether the US economy and the labor market specifically is weakening or not. Now, Trump is saying that there might be even some leaks coming out this afternoon or overnight at about the tariff announcement tomorrow. Besant, the Treasury Secretary, said that the big announcement technically is coming tomorrow in the Rose Garden at the White House at 3 p.m. So let's assume that it's going to be 3 p.m., but there could be sort of a little bit of a few sort of bits and pieces sort of dribbling out. Now, just in terms of the markets, it seems to me that if you just look at sort of price action, there's two kind of narratives about the overall effects of the tariffs. And I've been reading a bunch of stuff, and maybe I'll talk a bit more about this in tomorrow's video, but there seems to be some sense that what the market is pricing in or expecting loosely is something around about 9 or 10% tariffs across a broad range of countries. So it seems to me that the market is slowly coming towards some kind of narrative that consensus that less than 9 or 10% would be, not as bad as feared, and anything above 12, 14, 15% would be considered bad, and anything above 15 or 16% up into 18, 19, 20 would be considered very bad, and obviously something in the 20s would be very, very bad. But what we're starting to see, if you just look at the bond market, for example, we can see that there's two kind of narratives. Now this is the German 10-year price action, and you can see here that on the infrastructure spending and the military spending, almost 1 trillion euros, that was considered to be potentially sort of inflationary and expansionary fiscal policy. And we see here that the 10-year Bund sold off a lot. But since then, they've been kind of creeping back a little bit. And that's probably because of two reasons. I would say one is the realization that to actually spend this money is going to be a long-term process. And will only sort of, slowly sort of filter out into the real economy, so to speak. But also what seems to be happening is that we're seeing sort of concerns, not so much about inflation. And keep in mind that we had the European inflation numbers this morning, which I actually have here. And I'll just quickly pop those up so we just get the real numbers on those. So inflation in Europe seems to be lessening as an issue. You see here the EU, the harmonized flash number. So 2.2 headline versus expected 2.2, previous 2.3. So we're getting now down towards 2.2, a little less than last time and in line with expectations. So the inflation situation does seem to be sort of moderating in Europe and not too bad. Services is still a little bit higher, but overall, the picture there seems to be that inflation is not as bad as the US, and in some shape or form is kind of moderating down slowly towards target. So not such a bad issue. And therefore, that would leave the ECB free, in theory, if they want, to potentially cut another 2 or 3 times this year. So just getting back to what I was saying, is that the idea, the competing narratives in the market is this idea of, tariffs and fiscal stimulation in Europe will be very, very sort of bad for inflation. And not so bad for growth. But I think really what the market is starting to think about in the last few days, just really thinking about the tariffs, is that it's focused more on the growth sort of concerns. This idea that maybe growth in the US and China and globally and Europe will slow down a little bit, and that's giving the bonds a little bit more upside. So you see the bonds are in a kind of a tug of war, like in this sort of fight between worried a little bit about the inflationary effects of tariffs and potentially the maybe the more dramatic problem about actually slowing the economy. No matter what it is, we do have the European bonds up this morning. So see here the German bonds, also the Buchsel also up pretty strongly. What's going to be interesting though is that we are facing just a nice sort of Fibonacci retracement here in the 30-year bond, and you could argue that the long end of the German curve is the one which is going to be the most adversely affected by all this sort of fiscal spending and the continuing very heavy issuance of bonds, the 10 and especially the 30, which we're looking at here. So it's going to be interesting to see if, let's say, for example, this Fibonacci retrace level at about 121.10, whether that holds. If one was interested, if one believes that medium term, the Germans will continue to issue a lot of long-term bonds. There are some kind of inflationary pressures. If anything, this would be the one which should take a bit of the heat, the damage. So it could be an interesting short on a tactical level here. Although, of course, it depends on the Trump tariffs. If the Trump tariffs come in less than feared, this could be less of a concern about growth, and this could actually then revert to sort of issuance and inflation problems, and that could come down. On the other hand, if the Trump tariffs come in, as I just said, a little less than sort of feared, 6, 7, 8%, with a lot of sort of carve-outs and sort of exceptions, who knows, maybe the market will react in a different way. Just looking at other bonds here quickly in Europe, we see the French bonds, the OATs, going up in sympathy. No real problems yet about what's going on with Le Pen, so I won't talk about that too much. In Italy, also the bonds going up. So all across Europe, the bonds are going up. In the US, a similar situation. This morning, we had the front end doing pretty well. Came off a little bit yesterday, but basically doing pretty well. You got the 5s up, you got the 10s up, and you got the 30s up. So all across sort of global developed market bonds, you do have a bit of a push up this morning, so yields coming down. And again, probably that's the market. There were some rumors overnight that the Americans might actually be imposing higher than expected tariffs, maybe a sort of a blanket universal 20%. That would be, most commentators and analysts believe that would be a sort of net negative for global growth, for Europe, for China, for the US. Economies, and therefore one could argue that the Fed, for example, would need to start sort of thinking about cutting 2, 3, 4 times this year. Potentially also the ECB on track to cut 2 or 3 times a year. And so on, and that would be supportive for bonds. We shall see. Okay, so just looking at some other markets overnight, just looking also at the currencies. So what we're seeing here is that the US dollar is sort of hanging in there, not particularly showing any strength or any particular weakness. So let's just actually break it down a little bit. We had the RBA decision. This is the Australian dollar here. We had the RBA last night, which basically held a relatively sort of dovish hold because Governor Bullock said, and the quote is, the committee did not discuss any rate cuts. So there was no sense that, they needed to be in a hurry to keep on cutting here. So, well, I want to say a dovish hold, probably more of a neutral hold, but the Aussie, initially popped a little bit on the fact that they didn't discuss any more cuts. But as you can see here, the Aussie trading, pretty heavy. And again, that's been very much a proxy trade for China. This worry that, China tariffs, retaliatory tariffs, China not doing too well. So the Aussie, at this point being buffeted by sort of global concerns about the slowdown in trade and in China. And then if we look at the New Zealand Kiwi, also under a little bit of pressure here. And we also look at CAD. This is USD CAD. So you see USD actually going up quite a lot. And if we just look at the scorecard here, that's pretty much reflected. This is sort of a trend scorecard for all the FX. This is actually from yesterday, so it hasn't been updated today. But what you can see here is that this is the trends going back, like a sort of a volatility adjusted, and you can see here that the Aussie, definitely in sort of a negative trend here. And still quite red. CAD, not as bad as a few days ago, but still sort of down. We also see New Zealand. So you see here the three commodity currencies all sort of heading towards a red direction. Interesting what's doing well. You can see the neutral ones. JPY is sort of hanging in there as a safe haven. The pound and the Swiss franc not doing too badly. US is still, on a sort of a longer term trend. It's sort of in a negative kind of trend sort of pattern, but not as bad as it was. So kind of stabilizing here a little bit. You see here down -3. Euro still doing okay, but sort of softening a little bit in terms of the trend. You see that. And what is doing very well is the Scandinavian. So we've got the Swedish and the Norwegian currencies doing very well. I mean, Sweden was absolutely on fire like 10 days ago. So that trend is still very strong, but just sort of coming down a little bit. And of course, gold here on the spot, you see XAU and even the silver, but gold continues just to be almost sort of ridiculous in a certain sense. Well, I don't want to say ridiculous, but and just to put this into historical sort of context, sorry, I just got a chart here. So if you look at gold here, this is the quarterly change of gold. This is one of the best here, almost 20%. So really you'd have to go back, to the 80s. I mean, look at this. You have to go back to basically the 80s, 1986. To get a better quarterly performance. And just putting it here, just looking at some stuff here from Saxo, just this sort of, a cup and handle formation, it's the same, which took 13 years. And then it popped out. So there's the cup and the handle for the technicians amongst you, and then achieving its target within a year. So a very explosive move to the upside. So really the question here has got to be, is gold a sort of a sell at any point? Now we know all the reasons why people are buying gold, potential inflation hedge, geopolitical risk, debasement of fiat currencies, paper currencies, central bank buying, et cetera, et cetera. But when you actually start looking at the chart, we'll just throw gold on here. If I can find it, here we go here. So this is the spot price. I mean, the first little kind of hesitation today, this sort of a little sort of doji here, candle here. So just sort of starting to sort of hesitate a little bit. But look at the moving averages here, 20, 50, 100, 200, very, very, very strong. Every little retracement here is being immediately bought. I mean, this is like a pathetic retracement here and immediately three big strong up candles. So you'd have to be pretty brave to be selling it here. But if we just look at a couple of indicators here, getting towards the top of the Bollinger Bands. And again, if I look at just got a bunch here of sort of technical indicators and momentum and stochastics and whatnot. This particular sort of set of indicators, again, telling us it's getting towards the top of the Bollinger Bands, a bit extended. This yellow sort of indicates potential for at least maybe a short-term reversal here, very, very overbought. But still the upward momentum is there. You see these sort of turquoise indicators. So very much still in an uptrend. But as you can see down here, getting pretty much to overbought sort of levels here. Short-term tactical reversal, maybe if the Trump tariffs are less sort of onerous than feared, we could get just a little sort of reversal down here, just tactical, maybe not sort of long-term at all. But gold doing very, very well. Just while we're on the metals here, you see now look at gold, and then you compare it to silver. I see that silver has kind of just sort of hesitated along the sort of double top here. Again, this could just be a little bit of a sort of a consolidation reversal here, tactical reversal. Because silver too, let's be honest, is still in an uptrend. And if gold continues sort of piling up, you've got to say that silver might want to sort of test this double top and break through up to maybe in the mid 30s or so. On the other hand, we look at copper. Copper not doing great. That sort of arbitrage trade between the London and New York, that window seems to have closed a little bit. And just technically here, copper sort of pulling back. It's reached a lot of its targets. And you can see here, it's just taking a little bit of a pause. Although overnight, we did get Chinese manufacturing PMIs, which were higher than expected. So some of the other industrial metals are actually doing pretty well sort of overnight. But copper is just taking a pause at the moment. Now, just in terms of a couple of other things I want to look at, there's been a lot of talk here. Just want to look at sort of energy just for a moment here. So oil, as you can see, this is the continuous chart for the WTI. You can see that oil here actually doing quite well. We can see that It's actually broken above its Bollinger Bands. And if we look at something like its sort of moving averages, you look at the EMAs here, it's actually above its 100 EMA. It's got on this fib retracement going back, if we anchor it mid-January, you can see the fib retracement here. It's gone beyond the first kind of barrier, the first hurdle, which is the 38%, and also above the 100. So just from a technical perspective here, quite a strong breakout here. Seems to have been a basing formation. We've got a huge red candle yesterday, not so strong today, but yesterday. And again, based on this idea of supply worries coming from Iran, Venezuela, and maybe even Russia, Trump yesterday was on the wires talking about potentially bombing Iran, more sanctions on Russia, and then, ongoing sanctions potentially on Venezuela. So the next stop here, I would have to say, is maybe the 200 EMA, let's say about 72 and a half. And then you start to get into sort of at the top of this trade range, which is this pink box here. So interesting to see if gold can keep this up to 73. And if we just look at a few sort of charts, just want to go a little bit deeper, that I've just pulled up a few charts here from the Bloomberg on oil, just to put this into context, especially again for the American market here, or the WTI contract. So what we can see here, this is a crude oil production. So going back to, let's say, just after COVID, and you can see the crude oil production in the white has ground upwards, and we're getting up towards, about 13 million barrels per day. But as you can see, I've been reading quite a lot. A lot of people are saying that a lot of the wells are kind of tapped out. They're reaching their sort of capacity maximum, and they're no longer young and fresh. And so there's less pressure in them. And so the point is here that maybe oil production is starting to plateau here. Certainly seems as though for the last, let's say, what's this, year and a half, we're finding it difficult in the US, continental US, to get above that sort of 13 million barrels a day. So that could mean that less sort of oil production. On the other hand, if you look at this blue line here, this is the number of rigs. So this is the Baker Hughes number of oil rigs. And you can see that it was up to about 650. I remember back in the day it was up to sort of 800 or so. But what we can basically see is that there's less and less sort of oil rigs here. They are becoming more efficient. So the number of sort of barrels pumped per oil well is actually increasing in efficiency, but less sort of oil rigs. And again, that seems to be stabilizing. So we seem to be reaching some kind of point of equilibrium here, just in terms of production and the number of wells. And so that could argue that things are starting to get quite nicely into balance. Now, if we actually then look at the curve as well, the curve, as you can see, this is live data here for WTI, very much in a pretty strong backwardation here. So a pretty nice curve here. If we look, let's say, compared to a week ago, just to put this in a little bit of context, a week ago is the blue curve. And so you can see that not only has the spot price gone up from $69 to about 71, so up about 200 or 300 ticks here. But we can also see that the shape of the curve is a little bit steeper. And comparing that to a month ago, just kind of curious here. Well, pretty similar here. So the curve is still looking quite good in oil, quite constructive. Let's be honest. And then I think I had something else here. Also, just looking at Cushing, just in terms of inventory levels. If you look at the central hub for distribution and pricing for WTI, you can see we're at about 22.7 million barrels here, which, if you give it a bit of historical context, is actually quite low. And just to put it into context, you see something like in COVID, where no one was drawing down on oil and actually using oil. There are almost 70 million barrels in storage in Cushing, Oklahoma. But so what you can see now is that we're pretty much getting down towards historically low levels. And as we know that at Cushing, Oklahoma, and in those huge oil tanks, you can't actually have it completely empty, because just technically it's not possible to draw out the oil. So we're getting to points now where that's going to be potentially supportive for the front of the curve if market participants think that oil at Cushing, Oklahoma is becoming a little more sort of selling a bit more at a premium. Of course, Cushing, Oklahoma is not the only delivery point. We have all down along the Gulf as well. But just interesting here to see that the inventories are drawing down. And again, if we look at total US crude and oil stocks, this is excluding the Strategic Petroleum Reserve, but the crude oil is in the white here. So this is crude oil for the totality all across the US here. And what we can see is that, again, historically, we're getting down to not super low levels, but it is quite sort of low levels. Even the inventories for gasoline in the blue here are coming down. So point being that oil, just sort of some of the more sort of fundamental metrics are looking, quite constructive. There's always this sort of issue of trying to balance, supply problems, oversupply by OPEC. But then OPEC trying to sort of cut their production. Then you've got sanctions on, potentially Iran, Russia, and Venezuela, and then of course this whole idea of a global slowdown. So it's all sort of a bit mixed up. But at this point, if we again just to sort of keep it simple and go back to the chart is quite productive at the moment. But again, just it's going to start running into a little bit of resistance around about here. I would say like 73 or something like that. And so it's just going to be interesting just to watch the technicals here, just to see if we do get a slowdown in momentum on that one. So that's about it, guys. Actually, I just wanted to point out a couple of things before I let you go here, just as it's the end of the quarter. Pretty interesting just to look here at the way commodities did. Commodities actually had a pretty good sort of a quarter here. And just picked this up from just having a look here. So you can see that if you just look at within the commodities market itself, precious metals obviously probably led, pretty much by gold and to a lesser extent silver, had a fantastic, historically strong quarter. But you see also the softs did pretty well, energy did pretty well. The overall index, the Bloomberg Index, industrial metals and grains. So the commodities did pretty well and I just wonder if that's a bit of an inflation hedge as well. And just looking at some of the like on the softs here, just which we don't look at too much, but looking at Arabica, a coffee. I can actually bring up the chart here in a second, actually gone parabolic, up 22%. Very overextended kind of parabolic kind of price action there. If you look at live cattle as well, I was looking at some of the commitment of traders numbers yesterday. Live cattle actually doing very well as well. Sugar also up. What has been doing less well is actually some of the sort of agriculture. So we've got the corn pretty flat here, and we've got wheat actually was down. So some of the so the grains actually not doing so well, and cocoa, which had been parabolic, you see that actually has come off. So interesting to see whether coffee will follow in the footsteps of cocoa. Interesting to look at those two charts there, because we know that cocoa, had been parabolic and then has come off, about 33% in the last quarter. So definitely want to be looking at coffee. And actually, just while we're there, we may as well just finish off having a quick look just at that. I will just bring it up. I've got just a couple of these charts here. So if we look here at the softs here, just looking at, no, there's cocoa. So you see how cocoa came off, but just looking at, where's my coffee? You see here it's starting to come off just a little bit, but that's the Robusta. Anyway, we'll get onto that in a later date. Okay, so have a great day, everyone. Hope that was useful. So today, let's keep an eye out at 10 o'clock JOLTS and also ISM manufacturing, just to get sort of some read on the US economy, a little bit more information. And bear in mind that there could absolutely be sort of potential leaks coming out from the White House on the tariff information. All right, thank you very much. Have a great day.